Everyone trade head and shoulder pattern, but only 5% traders are successful, and 95% traders are unsuccessful. Spotting and correctly identifying patterns and understanding their significance are vital to successful trading. In this video, I'm going to show you how to trade head and shoulder pattern that works so good. Let's see how head and shoulders pattern formed. A head and shoulders pattern has 4 components. First, after long bullish trends, the price rises to a peak and subsequently declines to form a trough. Second, the price rises again to form a second high substantially above the initial peak and declines again. Third, the price rises a third time, but only to the first peak level before declining again. The first and third peaks are the shoulders, and the second peak forms the head. Fourth, a neckline can be drawn across the bottoms of the left shoulder, the head and the right shoulder. This is how head and shoulder pattern formed. Now it takes a deeper look inside the head and shoulders pattern. We will go through the individual points step by step. In this chart, this is the initial push to make the first high and formed left shoulder. Clearly, buyers were able to move price higher with little to no opposition from sellers. Price moved back into previous support and found buying power again. The sellers weren't able to move price past the previous support area, which indicates a strong imbalance between buyers and sellers. Price made a fresh high and formed head. The move up to the high showed again that buying power was much greater than selling power. After the new high, price did not make a new low, but it didn't make a new high either and formed right shoulder. At this point, sentiment hasn't completely shifted yet, but the bullish power is fading slowly. Now, we have a confirmed sentiment shift after breaking the previous support, the break of the neckline. Buyers weren't able to hold the support and sellers brought it down further. The break of the support of the right shoulder is usually the entry signal on the head and shoulders pattern because it completes the sentiment change from bullish to bearish. Now, most of you would spot a head and shoulders pattern and go short on the break of the neckline. And where do you put your stop loss? Above the head? Clearly your stop loss is large, and this results in a poor risk to reward. The market must have to move a lot just for you to make 1:1 risk to reward ratio on your trade. So is there a better way to trade the head and shoulders pattern breakout?
Yes!
It's trading breakdown with build-up. This means you'll wait for the market to form a tight consolidation near the neckline. And if the market does break down, you can reference your stop loss just above the highs of the build-up. Let's learn with an example. In this chart, you already spot head and shoulder pattern. Now the market directly breaks the neckline. Where do you put your stop loss? You have to put your stop loss on the top of the head. Here your risk to reward ratio will not justify because market must have to move a lot to 1:1. Risk to reward ratio. But in this chart, before breaking the neckline, forms a tight consolidation. And after consolidation breaks the neckline and you can make your entry. Here, place your stop loss just above the consolidation zone and this will be safe stop loss. You get a more favorable risk to reward compared to setting your stop loss above the high of the head. You might be wondering, but what if the market doesn't form a build-up and still continues to head lower? Won't I miss the move? That's a good question. And that's why I'm about to share with you my second technique called the first pullback. Here's how it works. If the market breaks down without forming a build-up, then wait for a pullback to occur. If the market does a pullback, then go short on the break of the swing lows. Set your stop loss above the highs of the pullback. Let's take an example. In this chart, market breaks neckline without build-up, so you did not get a chance to enter into the trade. But after some times, it gives a pullback with shallow retracement and small-bodied candles. Breaking the swing low, you will enter into the trade and set your stop loss above the highs of the pullback. Here your risk will be small and reward will be big. But what if you get a steep pullback and large-bodied candles? That's what I'll cover next. There are times the pullback is deeper than you expect. But don't worry because you can use the retest technique to time your entry and even short the market at better prices. Here's how. Here the pullback is deep, then wait for the price to come near the neckline or above the neckline. Now previous support turned to resistance. When price retests the neckline, then wait for a price rejection, like shooting star, bearish engulfing pattern, etc. If there's a price rejection, then go short on the next candle. Set your stop loss above the swing high or the rejection candle's high. Here you enter at much reasonable price, and main part is your stop loss is very small and target is big. Trail your stop loss from swing to swing and enjoy your profit. Okay, I just showed you how to identify head and shoulder pattern and make it a profitable trading strategy. All I ask for in return is if you can take 2 seconds out of your day and like this video. Thank you.